Bloomberg Audio Studios.
Podcasts, radio, news.
Turning to the Federal Reserve, cutting interest rates by another 25 basis points this month, but signaling the path is unclear for 2025. Fed Chair Jay Powell saying he feels good about the economy, but we are in a new phase in the fight against inflation. I'm pleased to say that joining us around the table, alongside Mike McKee and us, is the San Francisco Fed President, Mary Daly. President Daly, it's good to see you.
Nice to see you.
Thank you for giving us some time. Let's start with the forecast. Some controversy around the forecast. I'll go through the controversy. We don't speculate, we don't assume, we don't guess, and then a month later it felt like there was some speculation and some guessing about policy next year. I just want to talk about your approach to the forecast. Was it about the data for you, or was it about the incoming administration?
It's about the data. It's always about the data for me. We don't know what the incoming administration is going to do. You know, new administrations, no matter when they come, always put a slate of programs together. And really, as a policymaker, I want to see the net effects once I see clarity about what those policies will be. So I was focused on the incoming information and what it means for the outlook. And today, I feel like we've got policy in a good place, the economy's in a good place, and we are prepared for whatever comes before us.
What happened in the past 3 months that caused the Fed and perhaps yourself to be much more concerned about the stickiness in inflation?
Well, the data happened, and you look at the data, and what's happened is that there's two things that have occurred. First of all, the economy remains in a good place, and the risks to the outlook are equally balanced between a risk to inflation or a risk to employment. That's where we wanted our goals to be. And we adjusted policy when we had confidence that inflation was heading down, and we adjusted policy some more to ensure that we have a balanced labor market that continues. So that's where we are. But then the data on inflation have been coming in a little slower. I wouldn't even say sticky or stalled. I would say the progress is just slowed relative to what we had wanted, but that's a typical pattern. It's bumpy as you get to the, from 2.5 or 2.8 to 2. It's just a bumpy path. Yeah, go ahead, please.
But at the same time, some people were wondering if there was the stickiness, and I'm looking right now at, say, the Cleveland CPI now, and it actually has ticked up for the month of December from November. There was this question, why did the Fed cut it all?
Sure, and again, I'm going to reassert that it's bumpy. Remember earlier in the year, we had 2 months of data and people said, oh my gosh, it's reaccelerating, and then we had it come down. So inflation data, you can't focus on 1 month or 2 months. The most important thing for me was that we needed to recalibrate policy. I saw this as a close call. Was 75 enough to be the recalibration we were looking for, right-sized policy to meet the economy we expect, or do we need more? Ultimately, I determined that the 100 basis points was really the right level. Now I feel we've got that recalibration phase behind us, and we're in the next phase. And the next phase is really looking at the incoming information. We can return to a more typical pattern of gradualism for the Fed. We've practiced that where you, with a lot of uncertainty, you adjust the policy rate, then you wait watchfully, and you see what transpires, and then you make further adjustments. That's the phase I think we're now entering.
From September, the expectation in the markets was going into every meeting that you'd be cutting. Has that changed now? Should the expectation be that you won't be doing anything at any particular meeting? And from that question flows a second question. What are the criteria that you need to see to decide to go back to cutting rates?
Well, as you saw from the SEP, the median projection is 2 rate cuts next year. So that's already not every meeting or every other meeting. That's 2 rate cuts. I was very comfortable with that median. That makes sense to me. But we have to remain agile. I mean, the thing that's got us here is being resolute to achieve our dual mandate goals. Price stability was our focus when inflation was very high. The employment has come into the frame so that we're focused on both. But then we also have to be agile. The world is uncertain, so we pencil in 2, and as that estimate or that projection gets further from when we made it, the accuracy of it probably falls. And so we're just going to continually take in more information, consider it, and every meeting, your listeners should think about this, every meeting is live from the standpoint that you're debating, you're discussing, you're thinking what's the right level of policy. But my projection is that it will take many fewer rate cuts next year than we thought, but I'll watch the economy and see if that works out.
When we went into the cutting cycle, you were out front in saying you were concerned about the labor market and that we needed to make sure that we didn't lose the gains that we had. Now,
Absolutely.
at least coming out of Chairman Powell's press conference, it sounds like the focus has shifted to inflation again. Are you comfortable with that as this new phase that he's talking about?
Well, I think of it as a new phase as well, and I would characterize it slightly differently. I would say that for a long time, a persistent amount of time, protracted, we were focused almost entirely on inflation. That's because the labor market was quite robust and inflation was 7, 6, 5. That was the right way to focus. Then the labor market came into the frame. That didn't mean we turned our focus totally to it. It just meant that after a long period of focusing only on inflation, we were now focused on both. I think that is still the case, but I see policy as already in that position where it's supporting both. The policy is restrictive. It's going to continue to bring inflation down, and it's going to do so in a way that doesn't strangle the labor market, break it, and then give people lower inflation, but take their jobs. And that's not what we're trying to do. We're really working towards that soft landing.
Mary, you've used the word "we" a lot when you talk about what's happening at the Federal Reserve. We've had some people who are quite critical of the Federal Reserve and Chairman Powell's performance specifically in this news conference. One excuse that was given was that maybe he was struggling to reflect the lack of a consensus on the committee. How much diversity of thought, disagreement is there on the committee? You called it a close call for yourself. But was there some disagreement on the committee at this meeting?
Well, I'm not going to speak about the entire committee. When I say we, I stay focused on the things we all agree on, which is price stability and full employment, on our efforts to get there. What I would offer is that we have, in my mind, the healthy level of discussion and disagreement. You don't want an FOMC that thinks exactly alike. And I believe that what people are looking at is the fact that now the world is more uncertain and people are debating and bringing in their views, and that's appropriate. When it was a pandemic and there was only one direction to move interest rates, we had to do it quickly, it was obvious everyone agreed. When inflation's high, there was no disagreement, right? We're all marching up. Now you should expect more disagreement, more differences of opinion, but they're always framed to the same thing. How do we get inflation to 2 and restore or keep full employment?
When I hear the world is more uncertain, a lot of people hear, well, that's not about the data, that's about the incoming administration.
I would disagree.
Why would you disagree?
Because we have a variety of risks that are the ones we always deal with, right? The housing inflation. Right now, there's a substantial housing imbalance in the United States. The models in our data and our past experience all say housing inflation will come down, but we are uncertain about that, right? It hasn't come down as quickly as the models would have predicted, and so that's an issue. The labor market and consumer spending and growth are much faster and stronger than people would have predicted at this point, given the tightening we've done. There's a lot of uncertainty about the natural rate of interest. Where's the stopping point? And then, of course, there's geopolitical risks, the risk to global growth. That's going to be the backdrop, and then you have a change in administration. So I would say this level of uncertainty is normal in the sense that we've had all those things going on, and it's not as excessive uncertainty as after the pandemic, the financial crisis. Those were really big periods of uncertainty. So I think if you're a central banker, you just get used to uncertainty and you manage it.
Before we get into what some of the uncertainty about next year could look like, I am curious about how you're weighing how to preserve the job gains with the risk of running the economy hot for too long. And that's, I think, something people are struggling with. Is there an emphasis on the labor market, even at the behest of inflation, just because it's been deemed better for inflation to be a little hotter as long as people keep their jobs?
Yeah, I would characterize it a little differently, but that is a terrific question, and it's one we spend. As you know, Reserve Bank presidents spend a lot of time in the field, working in our district. I have the whole Western United States, and so I asked people the question, where are you on this? And again, I hear that the economy is sort of in a good place, right? Inflation's coming down, it's gradual, and the the labor market is solid, but there's one job for every unemployed worker. That's in perfect balance. And our firms are saying we can find workers, and our workers are saying we can find jobs. And no one really wants that to break. So what people do not want is a recession. And I think one of the reasons sentiment's been rising since the middle of this year is because the recession risk is now behind us in people's minds, and they feel good about that. So what I hear more than you would think is don't get 1/10 off inflation and then break the economy. That's like, we can be patient, but you just have to head for 2, and we don't want the economy to break.
That's why I thought it was interesting that the inflation forecast for next year was shifted upward, even at a time where the unemployment rate was shifted downward. There was a sense that that was okay to have 2.5% inflation at the end of next year, even though it was above 2%. Is that the sort of feeling right now on the Fed, to be more patient with inflation because it's thought of as less punitive at a level below 3% than, say, a rise in unemployment?
Well, let me just say how I think about it, because here I will speak for myself. I'm not comfortable with the rate of inflation being 2.5, but we're continuing to work on it. And so we might end up cutting rates, cutting rates less if inflation is as sticky as that. But what I'm also balancing is I don't want to see an unnecessary rise in the unemployment rate just to get a quarter ahead on the 2% goal. So that is a balancing act. And I think ultimately we were just looking at the information coming in and saying, there's a lot of risks out there. Inflation could rise, but you'll see, the inflation rising was partly why you saw the rate cuts pulling back. If we had 4, you'd see inflation go up more. And so this is a balancing act. But I think it also points you to the dispersion that you saw in the SEP, which I see as a feature, not a bug. You should have some dispersion when the world's uncertain. Otherwise, you would wonder if we're all in an echo chamber. But we're not. You can see that clearly. And you see the dispersion. And I think that dispersion really represents what we're facing. We might end up with fewer cuts than 2. We might have to respond and end up with more if inflation falls faster, or you see a significant weakening in the labor market. And I'm comfortable sitting in that center court position and waiting for the data to come in, and we'll agilely respond as they do.
Well, do you think there's any chance that you might have to raise rates next year?
I don't see that on the horizon right now, but we will always remain prepared to do what is needed to achieve our goals. But I don't see that in the span of the most salient risks right now that I face. But, absolutely, that's something that we never take off the table.
Who owns the dot with no cuts next year? Come on, reveal. Whose is that in 2025?
Reveal.
Not going to tell us.
No, I'm not going to tell you. I'm no rookie. I'm a rookie.
Just seeing how far I can push
It's not a holiday gift I'm willing to give you.
Are you kidding?
All right, I'm just checking.
Reveal. That was subtle.
President Daly's going to stick with us, I'm pleased to say. Thank you. Mike McKee, thank you as well, sir. President Mary Daly is still with us. President Daly, you were all about the data, not about the administration change. We do want to talk to you about how you would approach changes in policies from the incoming administration, though, across many dimensions: immigration, taxes, but the big one, I think, for many, tariffs. What's your approach going to be next year?
So we have all the tools and evidence from past historical periods. We can think about how these things will affect the economy. One of our biggest tools of figuring out how things will affect the economy is talking to CEOs of small, medium, and large companies, and we've already been engaged in doing that. So when we're out there in the field talking to people from across the country, and I'm spending my time in the 12th District, we're hearing that their sentiment is up. They're really optimistic, that they've been cautiously optimistic. They see the Fed's interest rate path falling, and they feel good about that. They see the economy as the recession risk is behind us, and they feel positive in general about some of the things that they think may change going forward. Now, whether that materializes or not, we will wait and see. But I feel that sentiment alone is causing us to have some enthusiasm, some cautious enthusiasm, if you will. One thing that we hear is that for firms that are worried about the immediate impacts of tariffs on their business, they're just building up some inventory so that they can have some insurance insurance. And so that's something you'll start to see in the data already. But I haven't seen that in such an outsized way that I think it's going to change the course of the economy.
One thing that you say, President Daly, is that we have experience from the past of tariffs, of some of the immigration bans or limits. But is this time more difficult just because of where we're coming from? It is a more inflationary time after a pretty big stimulus package injected into the economy.
You're feeling like an economist, like when you think of state dependence, right? The impacts of policies are affected by the state of the economy. So one thing that is on my mind is that we already have inflation above 2%. And so we have to work hard to get inflation down to 2%. And that is an economy that's just a little more vulnerable than it would be if we had inflation, at 2%, or when we came in to the tariff discussion or trade discussions last time, it was below 2%. So I feel on the other side, the real side of the economy is very strong or solid. And so we're in a good position, but it is on my mind that inflation's already elevated.
Well, does that make it that tariffs are more likely to be inflationary than they have been in the past?
It's really hard to say. I mean, one of the things you learn from doing this kind of a job a while is that it really depends on the scope, magnitude, timing of tariffs, and whether our companies in the United States are positioned to use substitutes and manage. And you see this happening. We already went through another feature that might make it less challenging is that in the pandemic, firms reshored, nearshored, friendshored, and you saw a lot of that behavior already taking place. So we'll see.
We just have about a minute, but in being agile, how concerned are you that people are going to label decisions as political?
I don't feel concerned about that. I think what we've done well is talk to the American people. The chair does that in his meetings. We do that. And we're telling them we are only focused on inflation and full employment. Those are the goals Congress gave us. We're going to do our best to navigate the incoming information, whatever causes it, and make the good decisions, make the best decisions, and then be humble about having made the wrong one or the right one and redo it. And think about it again. So that's how we're going to approach it. And I think ultimately people will judge us by whether we're successful.
You've been generous with your time this morning. We appreciate it. Enjoy the holidays.
Happy
Thanks
holidays.
for being with us. Thank you.
Bye-bye.
That was Mary Daly there, the San Francisco Fed president.